Harsha Upadhyaya, CIO for Equity at Kotak Mahindra AMC, with us on the show. Always good having him, Harsha. Thanks so much for taking the time out and being with us. Interesting times, interesting day today. Policy coming out in a few hours from now. Do you expect the policy to give any kind of bump up to the equity markets by virtue of the action or the commentary, or is it already in the price?
As far as equity markets are concerned, for the past several weeks, because of higher liquidity as well as better sentiments, we have seen markets moving up. I don't think RBI policy would really be another trigger for the move to continue, because most of the consensus expects 25 basis points of a rate cut this time around, and we think that's already priced in. And the market should not really make a big move because of the policy as such.
Okay. Harsha, what's the call though on the index at large, and divergent views coming in on whether we are overvalued or fairly valued, looking at the cycle that we are in? Rhythm yesterday was making a point that don't look at PE multiples for India because earnings haven't been trending. So if you look at price to book, I think we're still at the median and not really at the expensive end. So multiple arguments coming in. Where are you on the argument right now? And should you have the option to sit on some bit of cash while we are at record highs ahead of the election volatility? Would you do that?
Depending on which valuation metrics you look at, you could see markets trading at either fair value or fair value plus kind of a zone. Definitely it's not very expensive or very attractive at this point of time. So to that extent, I think some of the expectations already capture some amount of earnings improvement that is likely to happen next year. And also there is a hope that there will be a stable government post-elections. So given these two assumptions, market has rallied on the back of enhanced liquidity, mainly coming from foreign investors. So to that extent, in the immediate short term, we really don't see too many triggers for the markets to really make sustainable higher levels. We believe that until the elections are over, it's going to be a narrow range with some choppiness at best. And later on, depending on how monsoon comes around and how earnings season is expected to behave, then you will have a direction in the market. But until then, it could be a narrow range.
So what are you factoring in with regards to earnings, this time around? And leaving aside the approach to the markets over the next few months, as we await the election results, for the entire year, if you have to take a constructive view on the market right now, what are the few factors that you're going to keep in mind?
I think clearly next year's earnings momentum is going to be driven by corporate banks, corporate lenders in that sense. There we are fairly confident that there will be revival in terms of earnings growth, and that would pull up overall Nifty, Sensex, or whichever basket that you look at. What is critical for next year would be there is a considerable slowdown that has happened in consumer-led sectors such as auto, consumer durables, and even FMCG of late. So whether that pocket is likely to meet analyst expectations or not will be critical for the entire Nifty basket or the market to deliver the earnings growth that everyone is expecting. If you go back to September quarter, where there was no NBFC-led slowdown for some of these sectors, the basket really grew at about 15-16% in terms of earnings growth on a year-on-year basis. If you expect that to happen in financial year 20, then obviously with the kind of strength that you would see in corporate facing banks, you would reach closer to or to the levels of the analyst expectations in terms of financial year 2020 earnings, which is a significant 21% plus kind of an earnings growth. If there is a delay in terms of consumer-led sectors coming back to earnings momentum, then you would have issues even with corporate banks delivering better numbers. Then it will be difficult for the market to see that kind of an earnings growth. So to that extent, we are also positioned in sectors where there is a little bit of better visibility in terms of earnings. We are underweight on almost all of the consumer-led sectors, and that is the position that we will go into for financial year 2020. And as June quarter unfolds, we will review our position.
A view that we had got was that even though valuations at times are not conducive you look at prices and you figure out whether the prices of a good company are conducive enough to start investing in. Do you concur with that opinion? Is it also time to probably look at prices being more conducive right now, and for stocks which have really not participated in this big up move that we've seen, but are decent, good quality stocks having ROCs of about 15%, stable ROCs about 15% plus, are something that you need to look at?
We generally don't follow an investment strategy which follows that beaten down stocks should be bought irrespective of fundamentals, because even if there is a pullback, that won't be sustainable, and we always look for fundamental triggers, if there are any, for those beaten down sectors and stocks for us to really start investing into. Otherwise, we generally look for opportunities where there is a reasonable degree of visibility and the valuations are on the favorable side. So that's been our approach, and we will continue with that approach irrespective of market valuations. Just because market has gone to slightly elevated valuation levels, we generally do not attempt to get into some of the beaten down sectors, because in our opinion, some of the beaten down sectors are beaten down today because of fundamental factors, and just because more money moves into those sectors in the short term, it may not mean that they will really give you sustainable returns.
So based on that rationale, areas where you do see it being more risky to enter at this point in time versus pockets where everything on those parameters that you just mentioned gets the check?
Clearly, we have been avoiding sectors such as telecom, metals, and even we have taken an underweight stance on some of the consumer-oriented sectors such as auto, durables, and FMCG in the recent months. Clearly, these are the pockets where the industry fundamentals have changed for the worse, and also there is intense competition in some of these sectors. There are some regulatory issues in some other sectors. So overall, it's not a clear case where you would believe that industry will get back into the old times immediately, and in some cases the valuation may also not have captured the real problems that are there in the industry. So to that extent, these are the 4-5 industry segments where we do have either nil position or an underweight position.
Harsha, just one final question from mine at least. What's the outlook on information technology? The commentary from Accenture seems to suggest that Indian companies could benefit too. Today the index is the top loser. The currency has been strengthening, and maybe that has that sentimental impact too, even though we know that over the long term fundamentally companies hedge themselves well enough. But what's the growth outlook looking like, and would you be bullish about the prospects?
IT sector by and large should deliver market performer kind of returns in our opinion, and in terms of business the momentum has improved compared to 2018, but as you rightly said, there could be further pressure on margins because we are unlikely to see rupee depreciation this year. Compared to 2018, I think a lot of things have changed for IT sector. I mean, when you go back and see what happened in 2018 and why there was such a big rally in IT stocks, clearly a couple of factors helped. One, there was an under ownership in that sector from across domestic as well as foreign investors. You had rupee falling from higher levels to lower levels during 2018. You also had the market earnings growth failing to meet analyst expectations. In that scenario, IT actually delivered better than market expectations. And more importantly, for 3 to 4 years before 2018 beginning, the IT sector had not really performed well. So all these factors led to kind of a supernormal returns in 2018 for the sector. And when we get into 2019, some of these factors are no more there. For example, we don't expect rupee to depreciate the way that it depreciated last year. There is significant amount of ownership in the IT segment today. In terms of the earnings growth rates, it is unlikely to beat market earnings growth. So given all this, I think at best it will be a market performer in our opinion.
We'll leave it at that, Harsha. Thanks so much for taking the time out and joining us. Really appreciate your time.